Hi, everyone. I'm Rick Bensignor, and welcome to this week's In the Know Trader Show. Lots going on to start the day off with markets coming back from the Labor Day weekend. S&P futures are down about 20 points as we record early on Tuesday morning. Gold is up $10 despite the fact that the dollar is again ripping to the upside, making new multi-year highs. And crude oil is taking it on the chin a bit. Along with stocks mostly related to the newly implemented tariffs that went into effect this weekend. So oil's off about $1.20 or so. So markets are moving this morning. And what I want to talk about today, we always talk about the S&P to start the show. So that will be the first chart we look at, but I will mention that there's a possible new bear signal that we get today based upon where the S&P closes and what it does tomorrow during the day. So we'll get into details on that. And then this week, being that it's the beginning of a new quarter, let's take a look at the 11 macro sectors in the market, going everywhere from materials, communications, and so on, to just kind of get a sense of which charts are looking good, which ones have not made new highs that, of course, the S&P did earlier this summer, and plenty of these charts have not. So you'll see which ones have, which you can kind of take a guess that something like technology has, and real estate, because these things have been flying this year. But energy and healthcare are the two dogs. In fact, if we go to looking at our comparison of last week, so this is as of last Friday's close on the right-hand side, that's the sector performance versus the S&P, and on the left-hand side, it's 2 weeks ago. What we see, so we generally look at things that have moved 1% or more over the course of the week. So where we see some interesting difference is that utilities actually lost some performance last week. They lost about 115 basis points, beating the S&P by 5.6% this past week as far as year to date, whereas it had been 6.75% the week before. So utilities had a difficult week versus the S&P. Staples came down over 1% of return to, and of course that's because the market was up I think it was about 2.7% last week. So not a surprise to see the defensive sectors not doing as well. What else made the move here? Materials in the black bar, they had been down 5%. They're only down 3.8%, so it picked up about 1.2% of outperformance to the S&P. Industrials had a good week, also picking up almost 1.5%. And let's see, any last two, 14, nope. So those are the movers. And what we're going to do is take a look at each of these sectors on their own basis, not relative to the S&P, but just in absolute terms is what we'll do today. Just as a reminder, the best way to contact me is rick@intheknowtrader.com. Make sure you check out our website too, www.intheknowtrader.com. Lots of videos up there, information on some of the models we use. And of course, In the Know Trader is all set up to be a place you can go to that, unlike most other subscription services out there about the market, actually focuses on what institutions are doing. They are the main driver of price action, not the individual investors. And if you know what the institutions are doing, you have a much better chance of knowing what the market is going to do. And that's what In the Know Trader is about. So let's now flip to taking a look at our charts. As always, we start off with the S&P. A couple of interesting things here to notice, and I'm going to blow this up a bit so that we can really, let's see, there we go. So notice, Friday was actually an up close. And because it was an up close, it wasn't by much, but it was an up close, what it does is create the possibility for today to close beneath this purple line at 29.11. That's the propulsion momentum signal. Now you can see lots of times in the month of August we closed beneath it, but this would be one of the few times that a potential close beneath it came after a day that had an up close. And in order to kick this signal in and then play for or target 27.94, if we close beneath 29.11 today, and then tomorrow open lower than today's close, and also trade beneath today's low, you get a new signal, and it'd be the first time in all these attempts underneath that those three elements line up together to get a new propulsion sell signal, again, targeting 27.94. So price action today, right now, futures are trading at 29.03. It's still well before the New York Stock Exchange opened today, but at least as of now, the market should come under pressure to start the day, and it's got about a, we'll say an 8-point cushion or so when the market opens up beneath the 29.11 level. So there is a decent chance this can happen today. If not, it's just another failed attempt to get a breakdown that's not necessarily bullish, but it's again another kind of failure to get this done correctly. So all these attempts through the month of August, none of them lined up correctly to actually say that the next target down would be 27.94. So today is pretty important because of that. Otherwise, when we look at the market in whole and totality, you know, we topped right near our target of 30.32. We got to 30.28 on July 26th. That is the all-time high. We've been off a few percent from there. But this market has not truly cracked. And there's a ton of people in the bearish camp already. And what our model suggests is certainly we had a short-term pullback. Nothing has changed yet on the weekly charts to really change and to be net short on a longer term basis. The market just hasn't given those signals to us yet. Looking at the daily chart here, notice from the cloud chart, this blue line is nothing more than current price action pushed back 26 bars, and it eliminates all the highs and lows, and it's just close attached to close. So it's really like a line chart. So all this up and down price action in August is reflected here. And notice that there's kind of three equal closing lows right near 28.50. We've had 3 or 4 closing highs between 29.25 and 29.40. So we've really been in a tight range. But all this price action has occurred with the cloud lagging line, this blue line, occurring above its cloud. So even though price action itself slightly came under the cloud, the lagging line has not yet broken. Getting closes down, let's say a new closing low for August, you know, so closing beneath all these lows here would actually bring this blue line low enough to come out through the bottom end of the cloud, and that itself would be bearish because then all the cloud elements are above price action. So that's something else that we could look for. Otherwise, I'm not in the camp of being ultra bearish. I just don't see, I know the fundamental reasons why we could go into a recession. So far, the market, the stock market has not indicated that that's coming. The bond market has, the stock market hasn't. Typically, the bond market is considered smart money relative to the stock market. So you've got a dichotomy here, and you know, two opposing forces not saying the same thing. And my guess is that rates can still go lower, but that I don't think we're likely heading for 0%. The way, again, many bears think we will. So we play signals as they come, and as of right now, we are, for institutional clients, we are tactically short a half position at average price of 28.85. We'll get more short tomorrow if this new propulsion signal kicks in, but that is a pure tactical play. We would have to close this Friday beneath 28.79, which is very possible. we'd have to close beneath there on Friday. Next Monday, gap lower, and then sometime next week, trade lower than this week's low in order to shift the medium-term weekly charts into a more bearish type signal. So again, we take the trades as they come, and don't try to get too caught up into what you see on TV and read. Okay, so now let's make our way into our charts of the different sectors. So we're going to start off here with materials. I usually go through these alphabetically because they all start with XL as far as going through the 11 spiders. Let me tell you what will be on most charts to start, at least as default, and then we can play around with them if need be. But if you look at the red line here, these are all weekly charts. This is the 50-week moving average. The red line, the green line is the 200-week moving average. And of course, you have the cloud model here. So what's material say? When we peaked in July, they happen to be on a weekly sequential. It's an aggressive sequential, I can tell just by the color of it, upside exhaustion signal. And again, this is a model that helps separate what we do from other people. This institutions use this model, and it suggested the exhaustion point to the uptrend that had been in place since the Christmas bottom. Notice that even though price action was above the cloud, the lagging line stopped into its cloud. At the same time, we made a peak. And that would be a low risk sale for those who know these models. And we've come off now 5 or 6 weeks or so in a row. And we should open lower today. So this is kind of mid-range and nothing of particular to do right now, other than there is a shorter term. When I say shorter term here, since the market peaked, there is a shorter term type of negative count here. We're on a 5 count, and as long as this Friday's close is less than the close from 4 Fridays ago, which would be bar 2's close of 57.73, this is going to keep the negative bias in place. Clearly, you'd have to get above this high here from July, which of course is not the all-time highs that was made in January or early February last year. That would at least potentially get you up to the 60.99, so 61-ish level. Excuse me. So a minor negative bias here, and certainly this 13 is really important in the sense of having identified where this is running out of steam. Okay, let's move on. So after XLB comes XLC. Communications. Now, this you can see has much shorter price history because this was just made last year, so it doesn't have the history to look at like others. But most importantly is at least we see, since there's data for this, double top, almost even triple top. Certainly the 13s here, both aggressive and standard, on the peak. And the same, 5 weeks down now, where the close has been less than the close from 4 weeks prior. These often come in counts of 9. So it still would say that as long as we have pressure, you would look for another 4 weeks of potential downside bias. There's very little we can do. I mean, I can draw an aggressive kind of angled trend line here, and let's just see where. So we've played with it, but we're still hanging on to it today. This week's price action might very well break this, especially with last week having been an up close. We closed all the way up here. So closing underneath this week is potentially further negative. So not much reason at all to jump on the bandwagon at this point. If Friday closes above the close from 4 weeks prior, so above 49.62, and that's only 9 cents above where we closed last Friday, that at least gives you a little bit of reason to say we're holding the trend line. We've killed the current setup down count. Then what you do is look for, over the next few weeks, a proper breakout above 50.96. And then if that occurs, we would target something like 54.29. So that's, again, right in here, nothing to do other than watch and see what happens this week. Okay, next, energy. So energy, and let me take away some of these lines. So energy has been the dog this year, clearly the worst performer in relative terms. And in fact, if we were to look at XLE divided by SPY, the spiders, the S&P 500, you would see that we are on 19-year lows. That's how bad energy has been versus the S&P. 8 out of the last 10 years, it has underperformed. And right now, XLE divided by spider gets you a chart that's just awful looking and very close to all-time lows. However, when I look at a weekly chart, I see a sequential 13 signal from a few weeks ago. So that's this one right here. A couple of weeks ago, we get to 13. Doesn't necessarily mean it's the bottom. But let's look at the last few times I've seen 13 signals. This 13 here in the middle of 2017 nails the bottom. This 13 at the end of 2016 nailed the bottom. And this 13 here at the end of 2015 into the beginning of 2016 had both a 13 followed by a 9 a couple weeks later. We're on a 7 count currently, which means in a couple weeks, by not this Friday's, but the Friday after's close, we may very well have a 13-9 combo similar to here, which makes me think you might want to start looking at some names in the energy space over the next couple weeks. And that would be the first time I'd be interested in doing that in quite some time. So potential here for long-term, here, let's put a trend line going across. Doesn't have to be the exact low, but chance for a potential triple bottom going back to 2016, late 2018, and this year in the space. So if we don't get recession and the market doesn't come off very hard, it's possible that energy will be the place to look. So what would I want to look for? I want to look for beaten down names in the XLE, which should be easy to find because most of them are beaten down. Secondly, I want stocks that are cheap in valuation terms. And third, I want to find stocks that would be close to technical support, whether it's like this, a horizontal line from years ago, or propulsion exhaustion signals to the downside, or sequential 13s like this, something that would say that there's a good chance that you could be close to the bottom. So that's what I'm going to be looking for in weeks to come. So I am starting to potentially get interested in the energy space again for the first time in a long time. Obviously, lots of overhead resistance. We're beneath the 50 and 200 week moving averages. It won't be, this is not an instant profit type thing, but it's saying that there's a decent chance we're getting closer to a more important cyclical bottom in the energy space. So that's my views there. Next, we get it XLF financials. And financials have been struggling this year. Notice there's multiple 13s. So here on the all-time high, 1 week before the all-time high in January of 18, upside exhaustion signal is an aggressive one tucked in here, very close to the top in the middle of 2018, and then pretty much on this year's top. So all 3 peaks are accompanied by upside exhaustion signal. Now this picture is not as clear because when price broke above the cloud back in the summer, the lagging line did too, which could have gotten some people bullish who are cloud followers at very close to the same time that you see the upside exhaustion signal. And that's a tougher one to deal with because it's not as clear as, let's say, that first chart we looked at, materials, where when you got to 13, the lagging line was against the top of the cloud. This pushed through, getting some bullish at the same time. This was saying, look for exhaustion of trend. So financials are a tougher a picture here. Obviously, they're mid-range. In fact, go back almost 2 years, you're at the same price. So these have not moved up at all. Of course, the interest rate environment is the biggest thing hurting the financials. The low in Christmas was the 200-week moving average, very similar to the lows in early 16 and the spike down in 2015. So now that's up to a value of 24.24. That will be somewhat important if we really break it or not. Notice that the breaks underneath have been fairly only by a few percent at most, and then it comes right back. So if we get down there, that's something to pay attention to. Otherwise, financials, you're playing the interest rate market for now, and until rates stabilize and start going back up, it's going to be tough for financials to really get going. So it's not a sector. I mean, I can draw a trend line here from all-time high to the high we made in July. You need to break through that and do it convincingly to at least test and get up to all-time highs just north of 30. Otherwise, this one, again, this is a tough sector to be in right now. We'll get to ones that look better. But so far, we haven't seen like something that I can say right from the get-go is here's a sector I want to, it's a bullish chart and I want to add on strength. Most of these we've looked at have not been, and if, in the case of energy, it's really looking to bottom fish over the next month or so on continued weakness. XLI Industrials are next. Same thing here. All-time high made early 2018, subsequent 13 high in the middle of 2018, subsequent 13 high on this year's high. Downtrend line coming, all in the same line. So it's pretty clear that if you're buying strength, you want to buy a breakout above that line. There is a chance to get in before that, and that's based on the propulsion model. If we get a qualified and confirmed close above 76.67, so that's got to line up. That has to come after a down week in the market. Then you need a Friday close above 76.67 that opens higher the following Monday. And then sometime that week trades above the prior week's high. That then gets you a signal that would target 81 and 60-ish or so, kind of essentially a test of this area in here, the propulsion exhaustion area. On the downside, with last week having been an up week, if we close this week under 73.81, gap lower next Monday, and then take out this week's low, you get a new bearish propulsion signal that would target 68.5-ish. And then that would still keep this down count going. So chance it can happen this week to get an upside breakout. It could happen this week to get a downside propulsion signal. So pay attention to those. And this too essentially has a somewhat of a topping bias, a downward sloping trend line off of the highs, both points of which have upside exhaustion signals to it. So this still has a minor negative bias. Okay, after industrials comes XLK, technology. And let's get rid of these extraneous. There we go. And let's take this trend line out because there. So this is one of the obviously stronger places. You're above the 50-week moving average that's upward sloped. You're above the 200-week moving average that's upward sloped. In fact, you're well above them. If anything, it's somewhat overbought just because of the distance that you're away from. Look at it in just even in percentage terms. XLK is roughly trading at 80. The 200-week moving average is almost at 60. That's a 33% in round numbers price above the 200-week. It's pretty high even if you look back in time. That is a significant amount in percentage terms above one of the most we've seen, if not the most. Highs, all-time high was made, looks like 1 week after the 13 showed up. We got a pullback to the clouds baseline. That's this orange line here. We should get some early weakness. Pay attention to this. If this Friday's closes underneath 78.11, next Monday opens lower and takes out this week's low. then this is aiming for roughly 73.5. So that's what would be the initial downside target to a new propulsion signal that could come in as early as next Monday. Again, on the upside, because last week was an up close, you can't break out this week, but if this Friday closes down and the next Friday closes above 81.44, gaps higher the following Monday and takes out the prior week's high, that's a bullish signal, and would then say that 87.74 is the target. Okay, XLP, Staples, made new all-time highs last week, accompanied with an aggressive sequential 13. The last time we saw one down in here, which was not good, but we saw one here a couple weeks before the high last year. So this is somewhat riskier to first be a buyer now. If you like it, you wait for a pullback rather than just jumping after it now. However, the one thing that will have Staples going for it is if we keep moving higher, if the market keeps going down, then this should outperform and stay bid for. But because of the 13 here, I really don't want to chase after it right now. XLRE, real estate, also making new all-time highs. You can see this 13 here, got a month-long pullback. We have a 13 here that hasn't been confirmed. Any subsequent Friday close now that's less than the close from 4 Fridays back kills this count, confirms this 13. That would be negative. But REITs are doing well because low interest rates, and it's considered a defensive sector. XLU Utilities, also making new all-time highs right up against the risk level on this 13. So when you get a 13, there's also a place that tells you if you're wrong. We're right up against it. It can't get stopped out this week because last week was an up close. So anywhere from 62.78 up to 63.40 is near-term resistance. You'd have to blow through those in order to kind of make this a more bullish move and keep going towards the upside. XLV Healthcare, sideways since peaking. This one's different than most because unlike most, which peaked in early 2018, healthcare peaked in early December, just before the market fell apart. The upside exhaustion signals were kind of perfect there, has not been able to recoup since. But notice again that the lagging line has stayed above the cloud virtually except for one minor close here back in 2016, which gapped up the next week. This is not broken, so I'd pay attention over the next several weeks to somewhere in the low 86 level and whether or not that can hold. If it is, then healthcare still holds up in general terms. I'd be concerned if we started breaking down and got multiple Friday closes underneath 88.69. And the last one, XLY, also on 13s, that gives you some pause to really aggressively going after this, but this is one of the best sectors we've seen. Again, over time, well above its upward sloping 50 and 200. So this tells me I don't necessarily want to be a chaser after this now, but I would look for this on a pullback into support. So down near 111 or so is a place I might very well be interested. That'll do it for this week. Welcome back from the summer. And again, we could get an S&P sell signal as early as tomorrow. So pay attention to where we close today. Thanks for listening. I'm Rick Bensignor, and this has been In the Know Trader.